Whoa! I never thought about that!
Have you ever looked at a financial news channel and just stared at that little ticker scrolling at the bottom of the screen? You know the one, green numbers flashing, red arrows dropping, random abbreviations flying by. It honestly looks like some kind of chaotic secret code. And it can feel completely disconnected from our daily reality, right? But the crazy thing is, it dictates the wealth of nations, the retirement of millions, and the future of global innovation. So today, we're decoding it. We're breaking down the mechanics of the global marketplace to figure out exactly why those numbers literally never sit still. Okay, let's dive into this. I want you to imagine something for a second. Imagine you own a tiny piece of a giant, multi-billion-dollar company. Let's say Apple Inc. You own a tiny sliver of all those iPhones, those sleek computers, those massive retail stores. It's yours. But every single second you watch the screen, the value of your tiny piece of property is jumping up and then dropping down, over and over again in real time. It really begs a fundamental question. Who exactly is deciding these prices? Like, who has the authority to change the value of your property every single second of the day? So, to answer that, let's start with Section 1, the giant marketplace. We really need to understand the arena first. When we strip away all the Wall Street jargon, the glowing digital screens, and the frantic traders in suits, the stock market is exactly like an everyday marketplace that humanity has used for thousands of years. The only real difference, instead of buying food or clothes, you're buying stocks. And stocks, or shares, are literal pieces of ownership in a business. You aren't just buying a digital metric on a screen, you're buying a legal percentage of an actual, real-world operation. It's kind of profound when you really think about it. This brings us to Section 2, the pizza analogy. We're going to use a simple, everyday item to perfectly visualize how this ownership is divided up and traded. Imagine a massive, successful company as a whole, freshly baked pizza, divided into 5 equal slices. And this brilliantly illustrates our point. Each slice is a single share. Owning one slice means you own exactly 1/5 of that entire company. Now, here's the exciting part that drives the whole global system. If the company creates great products and thrives, the entire pizza basically gets bigger and more delicious. That means your specific slice just became much more valuable to anyone else who might want to buy it from you. But where do you actually go to sell your slice? I mean, you can't exactly walk into a local supermarket and offer it to the cashier. These pieces of ownership are traded on massive, hyper-regulated arenas like the New York Stock Exchange and the NASDAQ. That's where billions of shares change hands every single day. These are the centralized meeting grounds, mostly digital nowadays, where buyers looking to acquire slices and sellers looking to unload them come together to strike a deal. Moving right along to Section 3, the battle of prices. Now that we know what a share is and exactly where it's sold, let's get to the core mystery of those ticking numbers. This is a constant, live tug-of-war that dictates prices. It's the fundamental law of supply and demand. On one side, if you have a huge crowd of buyers chasing very few sellers, those current owners can demand more money. They have to sweeten the deal, right? So the price surges up. But if panic sets in and everyone wants to sell their slices with absolutely no buyers in sight, sellers have to drastically drop their asking price just to get anyone to take it off their hands. Prices plummet. It is a relentless, real-time battle. Let's look at Apple again in a practical, rapid-fire scenario. Step 1. They announce a revolutionary new product. Suddenly, demand skyrockets. Step 2. Fierce competition kicks in. One buyer offers $150, the next yells $151. Step 3. That immense buying pressure forces the overall market price up instantly. Conversely, if bad news hits, it triggers a massive sell-off. A wave of owners hits the sell button at the exact same time, and that immense selling pressure crushes the price just as rapidly. Which leads us perfectly into Section 4, speed of modern trading. But wait, why does this happen every single second instead of just, say, once a day at closing time? Well, it's because millions of people are processing an absolute avalanche of data simultaneously. We're talking quarterly company performance reports, breaking geopolitical news, inflation rates, raw investor panic, FOMO, and even unverified social media rumors. It all hits the global market at lightning speed, and people are buying and selling based on that info the very millisecond they process it. Crucially, it's not just humans typing on keyboards anymore. Welcome to the era of algorithmic trading. Wall Street uses incredibly powerful supercomputers and complex mathematical algorithms to execute massive trades. Before a human brain can even process a news headline, these algorithms have analyzed it, spotted the price discrepancies, and automatically bought or sold thousands of shares in mere milliseconds. Let's just take a breath for a moment here and zoom way, way back in history to the 1600s. Contrast those modern, hyperfast milliseconds of fiber optic cables with the 17th century. This was when the Dutch East India Company first began selling shares to the general public to fund these massive, highly risky global shipping ventures. Trading back then was slow, deliberate, and literally done on paper. But what's really fascinating is that the core concept, pooling our collective money to share in a company's ultimate success or failure, hasn't changed one bit in over 400 years. And that brings us to our final stop, Section 5, the human element. So the crucial point is, when we peel back the final layer of all of this, beneath the cutting-edge algorithms and beneath hundreds of years of market history, the whole system is profoundly, inescapably human. The constant, sometimes violent movement you see on that ticker is simply a giant, highly efficient mirror reflecting our collective fear, greed, and psychology in real time. Humans react quickly. We get terrified, we get excited, and we change our decisions at the drop of a hat. This brings us to a really fascinating realization to leave you with today. The stock market isn't just some random number generator or some abstract mathematical formula. It's a live, ongoing battle of millions of human decisions happening every single second of the day. Every single price change means someone, somewhere, decided to buy, and someone else, looking at the exact same information, decided to sell. So next time you're watching the news and you see that ticker price flash red or green, ask yourself, whose decision are you watching? Thank you for joining me for today's explainer. Keep questioning the systems around you.
And that's just one tiny big question. Imagine what's next, subscribe, and let's keep wondering.